Next section is the overall stock market. So I like to abstract out and try to keep things simple. The stock market indices only have two inputs to get to the stock price. One is how much companies are making and how much investors are willing to pay for those profits. And that gives you the stock price. It's that simple. And theoretically, if you can know what corporate earnings are going to be and what investors are willing to pay, you would know what the stock price is going to be in the future. If only it were that simple. But what is interesting is that there are drivers of these two things. And you can look at historically, statistically, how different things have affected these different components that go into the stock price. And while it's going to be impossible to get it exactly, there's an old saying, something like, I'd rather be approximately right than exactly wrong. And so I think there's some real important insights here to get us approximately right. So let's just look at each of them. What this is looking at, it's a busy chart, but it's fascinating. This is looking at inflation and PE. And PE is nothing besides how much investors are willing to pay for a stock. And what you'll notice is that this is the fourth major inflationary cycle that we've been in since 1900. So you'll notice back here, World War I, World War II, the 60s, Vietnam, the war on poverty, all the social programs, and the Apollo Moon Project, which was massive. And then here, COVID, okay? So a couple things that are interesting. One is when you get the first bout of inflation, it tends to not be the last. So it goes down, comes up, goes down, comes up, goes down, and comes up. That one had 4 major bouts of inflation, and the last one was the worst. You'll notice something very similar during the 30s and 40s. You got a bout of inflation, came down, up, down, up. You got 3 major bouts here in the 70s, depending on how you count it, 3 to 4 major bouts. And we're just kind of finishing up our first one. And then the last one, on all of them, well, it depends on how you count this middle one, but they tend to get worse over time. So they tend to take, at least 10 years to work themselves through. How they affect the price to earnings multiple, you'll notice every single time that we've had a PE inflation at the level that we've had it, called 7%, so being conservative on it, PE has gotten down to 15 every single time. And as things went through, it got worse over time. So, in many cases, it got down to 10 times PE. In all cases, it got down at least that low before the whole thing was done. Low inflation is wonderful. High inflation is very destructive to asset values, especially in the market. And you'll also notice that when you look at the PE during recessions, except for 2020, all the previous recessions going back to 1949, the PE gets to less than 15. So, a convergence, whether it's inflation or whether it's a recession, we'll probably see PE less than, about 15. There's a good formula for this that also converges with that, which is if you take the PE and add inflation, it should be 20. And so our PE right now is a little over 20. It's hard to know exactly because earnings are always delayed, but call it about 20, and inflation is, call it 6. So we're at 26. So for it to come down and be in line, you really want to see about a 20% decline in either inflation or the PE to bring things into line. And historically, we saw that PE come down to get this formula to more or less balance out. And it's never going to be exact, and you can't measure it on a day-to-day basis. This chart is looking at this one up here in a slightly different way. It's just plotting out inflation versus the PE year by year. So each dot is a year. And we've had deflation where costs went down, and people love the idea of that. But if you have debt, it becomes very onerous because you never want your income to go down, and your debt never goes away. So if your income goes down and your debt stays the same, it's very oppressive. And so whether it's a lot of deflation or a lot of inflation, it has the same general effect on stock prices. It causes stock prices to get very, very cheap, which is a great buying opportunity. As inflation goes down and as deflation goes up, they converge at about 2%. That's the optimal place to get the best returns. And the longer you can keep inflation at 2%, the higher the PE will go and the higher stock prices will go. And that's really what you saw with these surges right here, is PEs went way up, and it creates a pretty big bubble. So you can see going into 2021, the PE came up to 35. It did come down last year, 2022. PE came down to 24 because earnings went up so high. So that's helpful. That brings it down in the right direction. So that's PE. So we'll probably see PE come down quite a bit. And then earnings are fascinating. This is going back to 2000, it's the last 20 years of earnings. And you'll notice the ups and downs. That's called the earnings cycle. Earnings don't go up every year in a row. They cycle through. They always come down with a recession. Recessions always bring earnings down. In fact, this is looking at earnings and what recessions did to earnings going back to 1945. And you'll notice every single time it brings earnings down. In January of 1980, that recession only brought it down by 5%. In the 60s, even though some of those recessions were really bad, you're looking only negative 10, 14, 5, 12. So some are calling for only a 10% decrease in earnings, but that would be below average. So we'll see what happens. What really drives corporate profits are just two things. How much is the company selling and how much are they making per unit sold? Recessions reduce the number of items sold, and they tend to reduce the profits on those items because consumers just don't, when you have high unemployment and a recession, people just don't have as much money. To get back into the long-term trend line, you have to come back down to 20%. And if you were to get to the bottom of the long-term trend line, you're looking at a 40% decline, which is pretty severe. So hopefully that's not the case. And 40% is way above the average decline of 26%. Although, if you look at the last 3 recessions, they all declined by more than 20%. So we'll see what happens there. But the bottom line is directionally, it's hard to see a situation where in the short term earnings go up. It seems all the situations that they're going to be leveled down. And you can see that they've already started declining. So the market is still pricing in earnings growth. You can see the market is still expecting earnings to grow by 4% on the S&P 500 in 2023. So that's been revised down, and I would expect it to continue being revised down. When you put it all together, simply, it's just PE and earnings. If you look at where we started in 2022, 24 times earnings, $198 of earnings per share with the S&P 500, took you to a price of $47.66. That corresponds right over to the market peak. And then the sell-off in the market last year was nothing besides the PE going from 24 to roughly 20. So that accounts for the whole decline. That helps get things in line, but it would seem that there's still a long ways to go. If we did get down to 15 on the PE and we did have a 20% decline in earnings, that would get us to about 2,400 on the S&P 500, which would be about a 50% decline. And you can see that this right here is the long-term. That's 2,400. That's pretty low. That's about the COVID lows. That's where that would take us. There is a long-term trend line coming out of the great financial crisis, which is just shy of 3,000. So 2,400 is definitely lower than anybody's estimates, but I think it's on the radar. I think we just want to have a strategy that is prepared for something like that to happen. I definitely don't think this is going to happen. You can't rule anything out, but just to put you in perspective, most people's grandparents at this point, this is what they went through. If it had the same decline as the Great Depression, it would take you down to 715, which is the great financial crisis lows. So I don't want to freak anybody out, but from a historical perspective, it's pretty amazing what that generation had survived. And then they went from that into World War II. So it definitely deserves some respect for that level of suffering. So that's price to earnings and earnings.